copper seems to be more of a leading indicator for an economy. Do you agree with that?
Yeah.
And so can you help us understand why that is?
The IEA stipulates that all of its member countries hold 90 days worth of their normal demand for crude.
It's tough to make that call right now, but maybe there's a chance we are heading that way.
The world was producing about 3.5 million barrels per day more than we were consuming.
If 25% of that is in jeopardy because of the Strait of Hormuz that we just talked about, that's 20 to 25 million barrels. Hello, everyone, and welcome. My name is Philip Palumbo. I'm the host of the Palumbo Podcast, where we introduce and interview some of the most successful people running businesses, as well as portfolio managers and market strategists, to get their perspectives on the current state of the market. Today, we are fortunate enough to have with us Matt Bauer of Ned Davis Research, which is an independent research firm that my firm has been working with for several years now. Matt has great expertise in the commodities market. He's got over 26 years experience in the industry, in the financial industry, and we're fortunate enough to have him here today with us. Matt, thanks for your time. I appreciate it.
Thanks, Phil. Glad to be here.
Right. So Matt, the big elephant in the room, as you and I had discussed, is the price of oil. So as I've been talking to clients and any type of media interviews, the big question is where's oil going? And in my personal view, as I think about it, right, I think the Iranians are probably not going to give up easily. And I think their goal and objective may be to really make going through the Strait of Hormuz very difficult. And if that's the case, the price of oil could stay elevated for a lot longer. So with everything going on today and your experience around oil and energy, et cetera, what is your personal?
Right. It's a good question. A lot of it hinges, like you were alluding to, on the duration of the closure of Hormuz, which is not, I guess, officially closed in any kind of way, but functionally, right? We're seeing very little traffic actually make it through Hormuz. That's where, just to set the context, roughly 20% of the world's oil supply flows through every day. And so if you think about eliminating that, right, that's going to severely constrain the amount of oil that we have globally. So the longer it stays closed, the higher the price of oil is going to go.
Right.
I think at this point, we have not seen, at least that I'm aware of, this is it's pretty early, Friday, March 13th, we have not seen any significant damage to production infrastructure. So global capacity hasn't changed, right? Our ability to produce the oil hasn't changed. Our ability to move it is severely constrained. So really, it's a logistics problem at this point. And to your point about Iran, they don't seem to want to give up, and this is kind of their biggest lever to pull on, right? To get any leverage with the United States. So it becomes, how long can Iran last, and how long does Trump and Israel continue to want to engage with Iran, right? To see when it finally opens. There was some good news earlier this week. Saudi Arabia normally loads most of their oil above Hormuz and has to transport it through Hormuz. And they produce, I think, about 9 million barrels per day. I think their total capacity is about 12. They have a pipeline that runs west from where they normally load at the Abqaiq facility to Yanbo, which is on the Red Sea. They said that that pipeline was put in place after the crisis in '79, I believe,
Right.
Specifically for this reason.
Right.
And they were running about 1.5 to 2 million barrels a day through there, I think. Earlier this week, the IEA said they were running close to 5, I think, and they expect to be able to run about 7 million barrels per day through there at full capacity. Now, that doesn't mean that 7 million is getting out into the world, the global oil system immediately. There's still loading logistics and shipping logistics and that whole thing.
Right.
But there is at least some pressure relief there, hopefully coming from that pipeline.
So the IEA, well, going back real quick. So you said it before.
Yeah.
From what I understand, because of what happened in '79 and '73 and '74, that there was always this risk of Strait of Hormuz and other logistical issues. And that's why countries, I think that's one of the reasons why the IEA really came together, is to protect the global world from events like this, for example. And so I guess I just wonder, I don't think many people have the direct answer to it, but again, supposedly the world should be prepared for situations like this. So global oil is not disrupted. Is that right?
Right, not completely disrupted, and there's a little bit of buffer in the system. Um, Countries are members of IEA, and the IEA, there's no real enforcement function here, so who knows what the true measurement is, but the IEA stipulates that all of its member countries hold 90 days worth of their normal demand for crude.
Oh wow.
Right, in storage, and that's where these earlier this week they coordinated a release. I think it was 400 million barrels that they were releasing totally. The U.S. is doing 170 something million barrels per day. I think they said over 120 days or something like that. So it works out. We're in the U.S. We'll use that since it's local to us. That's an extra 1.4 million barrels per day that flows into the system. That's about 10% of the U.S.'s normal demand.
Got it. So it seems like there's some preparation tactics with this whole
Yeah.
situation. However, that doesn't necessarily mean that keeps the price of oil stable.
Right.
Because I'm assuming, like any other market, Matt, is these traders are going to trade oil based on their perception of where they believe the price of oil could possibly go to. For example, if the Strait of Hormuz is completely closed down. So even though you have these strategic reserves released, the IEA, like we just talked about, whatever US is releasing, it does not matter. But the only thing that matters is what markets perceive, like any other market, of what they think oil is going to go to if this conflict, as you said before, is longer in duration than people expect. Is that correct?
Yeah, exactly. And the way we've been thinking about it, so going into the conflict, prior to when the U.S. started dropping bombs on February 28th, the world was actually had a surplus of oil. So in addition to
Right.
all of the storage, right, the world was producing about 3.5 million barrels per day more than we were consuming. So the market was well supplied. And that's really what kept a lid on prices, for the last 3 years, right? Was supply was
Right.
outpacing demand. So that was very helpful, right? This would have been much worse. We would have seen much higher prices much quicker had we been in a structural shortage of oil when this
Oh,
happened.
definitely.
And so there's this so the way we've been thinking about it is there are two components to a premium that we think are being added to the equilibrium price of oil, whatever that price is, right?
Right.
To balance supply and demand. There is a balance component which takes into account that initial kind of surplus that we had, plus the storage facilities that can be released and kind of, pardon the pun, grease things over a little bit, right? Help them move along.
Right.
And then there's a risk component, and that's just basic volatility. It's an increase in friction, right? Even if Hormuz opens today, it's not going to immediately return to its full capacity for a
Right.
variety of reasons.
Right.
One of them will probably be that convoying is going, like if the naval has to escort tankers through the strait, that's not going to be as quick as letting them go by themselves, right? Because they'll have
Right.
to get them all together and escort them. So there's a little bit of a friction component, a volatility component, and then there's a tail risk component that I think still exists, and that's small probabilities of large moves, right? And so it's improbable as we progress through or becomes less probable as we progress through this conflict that Iran is going to be able to target production infrastructure. They're going to run out of missiles, right? Their capabilities are going to be degraded. So the probability of them blowing up something significant that produces crude in Saudi Arabia diminishes. But if they do that, that magnitude of the shock to oil prices is going to be huge because it's no longer a logistics problem, it's a capacity problem, right? And so we take those things, there's the balance component, our risk component, and we add those onto the price of oil. And as Hormuz is closed for longer, that balance component, right, starts to push the price up because we've eaten away all of our excess supply and the surplus and stuff like that. Now, some of the risk component might come down a bit because markets tend to price things by with high volatility following the event, but that volatility and risk component tapers down as markets kind of normalize, and we're like, all right, this is the new normal. We understand these risks and we can price them more effectively. So
Right.
the base case might be nothing else changing, that we continue to see a slight uptick in oil as we progress through time if there's no resolution to the conflict or Hormuz.
Right, which makes total sense. And so for me, I just, just for my audience listening, I really want to wrap math around this. So for example, the whole entire world, the global world, it consumes 100 million barrels per day, right? So if 25% of that is in jeopardy because of the Strait of Hormuz that we just talked about, that's 20 to 25 million barrels, right? So if the IEA releases 400 million barrels, that gives us about 1 month's worth of coverage for that 20 to 25 million. And that's what this all means from simply a math standpoint. However, if you start to go beyond that 1 month, and I think if oil markets start to sense that, that's where, like you just said before, that creates some instability in price. And nobody really has a definitive answer to that. But I guess, the way I think of it is, if the U.S. can't combat Iran in a short period of time, I think that in itself is an issue. But the Iranians, again, can do a lot of things to, they're creating mines in the Strait of Hormuz. So that's, these are the known unknowns, which I constantly talk about. But it's good to just be educated to understand things. I just want to ask you also, in your personal view. So when clients ask me, isn't U.S. energy independent? And the answer is sort of, not a definitive yes. Correct? Although it's being portrayed that we are energy independent, but we're really not.
Right. It's easy to come to that conclusion because we produce more crude, right, via shale than we consume, just on a barrel basis.
Correct.
But the way our refineries are set up, they can't process a lot of the crude that we actually create. And so we import a fair amount. But the good news is only about 10% of what we import comes from the Persian Gulf. Most of it comes from Canada. So as long as we're not entirely antagonistic to Canada, our supply is relatively safe.
Right. So, and from what I understand, like you just said, so in other words, when we take crude out of the ground, and then from a refinery standpoint, there's certain things that we can't refine within the setting of oil, and that's why we depend on Canada, and that's why we still import certain oil products. Is that the way to think of it?
Yep.
Okay, great. So I want to turn now to, which is one of the reasons why I reached out to you prior to the war, was more about the idea and story about this long-term commodity run. So just give some perspective. And I remember Jim Rogers, right? So Jim Rogers back in 2000, I think he wrote a book about this too, and he nailed it. 2013, the commodity market just ripped, right? And really that was a function of China. That was really the China story, China building out and their need for commodities, et cetera. So, but first, so I want to talk about, are we in a long-term bull market in commodities? But before we get there, let's just, as you and I spoke about, let's educate the audience. When we say the word commodities, like, what do we mean? How do we break that down?
Right. So the way we look at it, there are basically three broad indexes, like the S&P 500 for equities, three broad indexes that track commodity prices. And it generally tracks everything from crude, like we've been talking about, energy commodities, natural gas, metals, whether they're precious, gold and silver, or industrial, like copper, agricultural commodities, wheat, corn, sugar, and then livestock, pigs, cattle, that sort of thing. There are three indexes that, through varying composition, try to track the broad movement of those commodities. So if you think about the S&P has 11 sectors, right? There's technology and finance and healthcare. Commodities are the same way, but it's the way many of them break the index up is similar to the one that we use, the S&P GSCI index, which has 5 sectors for industrial metals, precious metals, energy, livestock, and agriculture. And so the three big indexes are the Bloomberg Commodity Index, and I think that's the index that actually has the most money indexed to it. The next one's the GSCI. That's the one we use as our benchmark.
Right.
And then the CRB index, which is actually popular because it's the closest to an equal weighted index.
Right.
The concern with the index that we use, the GSCI, is it has a heavy energy weighting. And so its performance is largely dependent on what oil is doing.
Okay, so that's the breakdown of everything. So when you go into a long-term bull market, I mean, it could be maybe it can be because precious metals are really rallying because there's a need for certain parts of the precious metal sector, like copper, for example, is very big, especially
Right.
with AI going on. I mean, so generally, so we invest for clients in what's called DBC, right? So DBC, for example, on a year-to-date basis is up 28%, but a large component of that, as you said before, really is energy. So when the price of oil rises, as we're seeing, you're going to see DBC really perform well, and
Right.
other types of funds like that. So, but the bigger question, like 2000, 2013, is it was the China story that really brought commodities to high levels and brought into a secular bull market. And so when you think about today's story of AI and the build out of AI, you can almost argue it's very similar to China, because we're talking about a $1 to $2 trillion story in terms of spend, right, over the next, I don't
Right.
know, 2 3 years minimum. So, and then within the sectors, industrial metals, precious metals, those are probably the two areas that can perform well if we're in a secular bull market. So, what is your perspectives about that, about secular bull market and commodities and maybe specific sectors?
Yeah. So it's actually a debate we're having within our firm right now. So since you're a client of our firm, you know that we like to rely on what we call the weight of the evidence, right? We look at a basket of indicators, trying to make an assessment for whatever market we're looking at, as opposed to relying on one or two
Right.
indicators. And so one place to start was looking at those three indexes that I described. And the reason I think we're seeing a lot of discussion about a commodity super cycle is the performance of commodities off the COVID low, right? Everything sold off in early 2020 because of COVID, demand destruction, that whole thing, and rebounded sharply, and commodities participated in that. And so if you look at those three indexes on a chart, all three have done very well, off that low. What's
Right.
interesting is only and you were talking about the China-led commodity boom in the early 2000s from, I think we label this the previous secular bull from 98, I think, to 2011. Only the CRB index of those three has set a new all-time high. The GSCI is actually well below its 2011 high, and the the Bloomberg Commodity Index is even lower.
Really?
Yeah. So you could even, until recently, until this recent energy and fourth quarter metals rally, I think you could have argued that the Bloomberg Commodity Index was still in a downtrend. That's changing. The fourth quarter rally in the metals, this energy rally has changed the nature of those indexes. So maybe from that perspective, maybe looking at these three indexes is swaying a little bit more towards yes, we're in a secular bull environment. But it's not conclusive from those three. So we've also looked at, and we're discussing some broad measures of economic performance that are impactful to commodities. One of those is money growth. So the money supply, and we look at year over year M2 money growth for a large portion of the globe. We look at China's, the US, Eurozone, UK, Japan, Canada, as a sum total, their M2 supply in the year over year change in that.
Right.
When it's moving up consistently year over year, right? Money supply is expanding, commodities tend to do pretty well. And we saw that with the early 2000s previous super cycle. This time, 2025, we actually saw pretty good money growth, but in 24, 23, 22, it was pretty anemic.
And Mark, Matt, if I could stop you real quick, and you're
Sure.
right. I mean, when you look at the performance of the Bloomberg Commodity Index, from January of 2022, and that was the most recent high, and it's still not there right now.
Right.
So to your point, so you're saying that M2 or money supply growth has been anemic since over the past, really, like you said, 23, 24.
Right.
But in 25, we start to see a little bit of a pickup.
Yeah, and anemic may be overstating the case, but certainly lower than what we saw during the previous super cycle.
Right.
So that's not confirming the secular bull commodity case. So we looked at industrial production, global
Right.
industrial production. Similar story there, both from off the lows in 2020 until now, and over the last 3 years particularly. Now, industrial production has improved in the last 3 to 4 months, so it's looking much better. But over the last 3 years, we've been much lower than what we saw, both on just an average year-over-year change and the number of months that are above 3% change, well below what we saw during the previous secular bull. Similar story with the purchasing managers index, also below what we saw. So those indicators are both improving, right? Actually, all three of them: money supply, industrial production, purchasing managers index, are improving in the last few months. But over the last 3 years, we really haven't seen them at the levels that we saw during the previous cycle. And so I think you could make the argument. So one way to look at it would be that, yes, we are off the COVID lows. We're rallying hard. We're in a new bull. That's a fair argument to make. And I think the way that the people making that argument would look at those current indicators is that we've paused over the last 3 years, but if they start to accelerate, that's an indication that we're resuming that secular bull, right? And that's fair. And then we would look towards the other indexes, right? The GSCI and the Bloomberg Commodity Index to make new highs, and that would add further confirmation.
So right now, you sort of like it. So right now, Matt, you're in middle ground to make that definitive call as far as secular bull market in commodities. Right now, in your belief, losing quantitative data,
yeah,
right? It's tough to make that call right now, but maybe there's a chance we are heading that way.
Right. Yeah, I think it's hard to say definitively. And what we're lacking now, AI, the grid, renewables do provide a good demand story.
Right.
But we haven't seen it flow through to commodity prices broadly like we did with China. And China is probably going to be absent this time around. I mean, it's still a huge economy, right? But it's not growing like it was. They're actually shifting away from building buildings and shifting towards building machines, which may not create as much demand that we've seen from them from prior commodity rallies. So
right. So I think that's a great story. So there is this potential. So when you really tie it together, right now your indicators are not showing you that we're definitively in a secular commodity bull market, but it's moving in that direction potentially, number one. But number two, the fundamental and demand side of the story, like we just talked about before, and if you tie it all together, there's a high probability we can be in this secular commodity bull. And a lot of things I'm reading about is pointing that direction. So great information there. I just want to quickly go through three more parts to this conversation. Sure. Copper. So copper seems to be more of a leading indicator for an economy. Do you agree with that?
Yeah.
And so can you help us understand why that is?
It's used in virtually, well, not virtually anything, but it's widespread use in manufacturing everywhere.
Right.
It goes into homes, cars, buildings, electronics, the grid. So it's just a widespread commodity. And so when the economy turns up and more stuff gets built, there's greater demand for copper. Now, one thing to keep in mind about copper, though, is it's more or less infinitely recyclable. So it's not like oil where it's pulled out of the ground, we consume it, and it's gone. Anytime you pull copper out of the ground, depending on the price of recycling, right, or the price of copper, which makes recycling economically feasible, once it's out of the ground, you can continue to reuse it.
Yeah, so you see commodities here when I'm looking at some of these funds that are out there. I mean, it's just a huge explosion in price, right?
Yeah.
Which is a telltale sign of the economy, which, I'm a fan of the economy being strong. But now with the war, it's obviously there's some issues really to watch out for, like anything else. I want to turn to gold. Is gold a commodity?
Classically, I think it would be classified. Yeah, I mean, I think you would classify it as a commodity. It's a precious metal.
Mm-hmm. So with this move of gold that we recently had over the past year or 2 years, has been unbelievable. Do you have a personal opinion about that?
I think a lot of it's been driven by the movement out or away from the Western financial system and concern by sovereign entities that are less friendly with the West, looking to diversify their holdings. And this was, a lot of it was precipitated by Russia's invasion of Ukraine. The U.S. seized a bunch of Russian assets, right? And so countries that are not necessarily friendly with the United States, so like China, clearly Iran, North Korea, Russia, want to move out of dollar-denominated assets and into hard assets like gold. And so we've seen a big, like China's central bank has been buying a ton of gold. And so I think it's that diversification that's been a big stimulant of the bull market.
I totally agree with you. I remember when Russia invaded Ukraine and all the sanctions we put on Russia, and Russia had heavy dollars at the time. So to China, and I said to myself, "Gosh, if I'm an adversary of the United States, the last thing I want to own is dollars."
Right.
And that's why you've seen just a massive amount of buying, especially from China, over the past really 12 months. And that's why you see the price of gold rise a lot. But gold is you can almost tie gold to the currency as well. There seems to be a negative correlation to the price to dollar. There seems to be a risk off trade, when risk is on trade. Gold is a good hedge. So gold is interesting relative to other precious metals, the ag sector, and other commodities. So that's why I've always personally never really looked at, even though it is a precious metal, I've always looked at it more like a hedge against a down market, a hedge against inflation, a hedge against the dollar. That's kind of how I always looked at it. I wanted to ask you again.
I was just going to say, within our firm, we do that as well. Like our call for gold is distinct from our call for commodities. So we kind of take it out of the commodity umbrella and consider it as a separate asset.
Yeah, I agree with that. And then just a quick answer to this: cryptocurrency, is it a commodity?
I don't think it is. I'm not sure what the argument would be there. I think digital asset, maybe the classification I would go for. So I'd put it under the alternative asset bucket along with commodities and private credit and private equity, but create a distinct digital asset sleeve, if you will.
I agree with you. And then lastly, Matt, to close this conversation up, is commodities within a portfolio. In the research that I've done, historically speaking, it seems that a basket of commodities is not really a great long-term investment. In fact, many of the statistics that I've looked at going back 1,500 years has averaged between 2 and 3%. However, there are these times, especially the super cycles like we're talking about, where it could average 15% over a 10-year period, right? So in terms of the benefits of owning commodities from an investment standpoint, what is your view?
I think you're right. I think the evidence doesn't support, or at least recent evidence doesn't support a strategic allocation towards commodities, where you would systematically own X% consistently. I think to your point about super cycles, and even individual commodities that may go on long bull runs like we've seen with gold, you could make an argument for tactical allocations within a commodity sleeve. I think that makes sense. But the long term, we're just going to own 5% or 10% of the GSCI, I think is a tough argument to stand behind.
Yeah, I agree with that. So Matt, this was an excellent conversation. I really appreciate it, especially the current environment we're in, especially with the big elephant in the room, which is oil. I think you did a great job, clarifying that or helping people to understand it. Obviously, we don't have a crystal ball. We don't know where the price of oil is going. There are definitely risks out there as we know it. And, we just hope that this war ends sooner than later, which would really, at the end of the day, help the price of oil stabilize and even go lower. So that's part of it. So Matt, thank you so much for your time today. I really appreciate it. Continue to keep in touch. You're you're a tremendous value to my firm in every aspect. When I need you, you're there. You pick up the phone, get on the phone with me and help me out, understand certain things like we're talking about today. So thank you for all the work that you do.
Thanks, Phil. We appreciate it.
All right. Thank you.